Hello, everyone. Thank you for joining us today. My name is Aska Sonoda, and I'll be one of the speakers today. I'm a financial planning assistant at Kondo Wealth Advisors. I'm an enrolled agent and currently working on getting CFP certification. I joined at Kondo Wealth Advisors in 2021. Prior to that, I specialized in tax preparation and also estate planning for expats at Japanese tax firm. I'll be speaking with Akemi Dalvi today. Akemi is a president and CEO of Kondo Wealth Advisors. She is a certified financial planner and also a CPA with personal financial specialist credential. She writes financial columns in the Rafush Info, as well as East San Gabriel Valley JCC Newslet. She also co-authored a book with Alan Kondo. It's called Retiring Upstream. Akemi, do you want to say hi to everyone really quick?
Good morning, everybody. Thank you for being here. We're excited to share with you.
So before we jump into the presentation, here's a little bit of housekeeping items. Thank you again for everyone to be here today. You all are muted and you're not visible, but you have an option to ask questions by Q&A button at the bottom of your screen, and we will answer the question at the end of the presentation, which should be about 45 minutes. Those of you who submitted questions at registration, thank you so much. It really helped us to guide the presentation, and we try to incorporate as much as possible. But if your question didn't get to the presentation, you don't need to submit it again. We will address the question at the end of the presentation. If you have any question that's particular to your situation, let us know, and we're happy to discuss with you complimentary for anyone who attend webinar today. Our contact information is at the bottom of your screen. You can call us, you can email us, or you can send a Q&A and ask us to reach out to you after the presentation. So thank you again for everyone to be here, and now let's just jump into our agenda. Our agenda here today is first, Akemi will be discussing about Federal Reserve's monetary policy to address inflation and also how that affects the future economy. Then I'll be talking about recently passed legislation, Secure Act 2.0, and also how you may get affected by that. Then I'll give it back to Akemi, and she'll be talking about investment strategies to utilize current market environment for long-term growth and also keep your financial goals on track. Then we will finish with Q&A. So I think enough for me talking, so I'll pass it to Akemi, and she'll get it started.
Thanks, Aska. Thanks for the great introduction, and thanks everybody again for being here. Let's start with a market recap, because of course, last year is going to still influence where we're going in terms of 2023. So 2022 was a tough year for the stock market. We were pummeled by Fed policy in the form of interest rate increases, as well as some of the reverse of the quantitative easing policies that were done during COVID. So that was difficult for the stock market all year long. And then there were other things that happened as well. We were constantly worried about whether we were going to be declared in a recession. The Russia-Ukraine war just continued to go on. And so I think a lot of people are glad to say goodbye to 2022. This is actually what it looked like. This is the Dow for 2022, and it so closely resembles a roller coaster. We started 2022 at a high, roughly 36,000 on the Dow. We dropped to a low of about 28,000 on the Dow in September. Had a good Q4, made up some of those losses and closed around 33, but it was just a volatile year from beginning to end. Now, of course, the Dow is made up of 30 stocks. If you want to talk about a broader index, let's say like the Wilshire 5000, which is the total market index, so the broadest measure of US companies. That was down as well, closed the year at about 19% down in 2022. And that was even after a gain of 7% in Q4. So not an easy ride for anybody. Most of this was driven by Fed policy domestically. The Federal Open Market Committee, the FOMC, raised rates 7 times in 2022 for a total of about 4.25% interest rate increase to the Fed funds rate from beginning to end. That increase happened in just 1 year. It's the fastest that we've seen rates increase in a single year since the 1980s stagflation era. And that was a really difficult time to be in. A lot of the way that we saw the inflation take place was through things that we saw at the grocery store, at our gas pumps. I know a lot of us tried to forget, but do you remember when gas prices were like $7 or $8 a gallon? It was so painful. And that's why the Fed's response was as strong as it was last year. This is a chart of inflation from the 1970s through last year. If you look at the very far right end, and I'm going to get a pen out so we can look at this together. This is just the 2022 section. Over here in the summer, inflation peaked at about 9.1%. Thankfully, it dropped. We closed the year at around 6.5% after very aggressive Fed policy. But the inflation is the highest it's been since the 1980s. And before that, the 1970s. Now on this chart, you might see these gray bars. These gray bars are indicative of times where the US was in a recession. So if you look at this, you'll notice that the recessions hit either at the peak of inflation or just shortly thereafter. Now for the US economy, if you're looking at GDP alone, 2 consecutive quarters of negative GDP, we did hit that benchmark in 2022. But the Bureau looks at other things more loosely to define a recession. And we had strong consumer sentiment last year until mid-year when inflation peaked, but also the jobs numbers. We were at an all-time low for unemployment. So those things together prevented the US from saying we were technically in a recession, but that's definitely on everybody's mind for 2023, especially when you look at a chart like this. Looking back again at the sectors of performance from 2022, the US market was down about 19% last year. Energy was the only section to close in the green last year. That was generally due to tight supply, high demand, and just overall uncertainty about the economy and supplies and scarcity. Arguably, it was in the green also because some of the pricing that was related to that supply and demand issue, but that's probably a whole nother conversation. If you look at the other sectors, utilities and consumer staples, things that are very defensive, they did all right. They were kind of flat. But if you look at growth sectors, consumer spending, like discretionary items, those were hurt the most. Last year, they were down about 36% and 27% respectively. So that being said, as the recap for 2022, what's the outlook for 2023? Well, like last year, I think a lot of the policy from the Federal Open Market Committee is going to have a very big effect on the stock market this year as well. So the Fed has verbally stated that they have a steadfast commitment to fight inflation. They acknowledge that the risk of tightening the economy too much is present, but they feel like inflation is a bigger long-term problem that they need to focus on. And that's why they are so adamant about raising interest rates, not only through 2022, but continually through 2023. We mentioned that we were able to get inflation down to 6.5% at the close of 2022, but the Fed's overall target is 2%. So you can see there's a gap there that we still need to close. The Federal Open Market Committee has said that they do not plan to cut interest rates in 2023. In fact, they plan to continue to raise interest rates. The expectation is that the Fed will probably raise interest rates in February, which is only a week or two away. And that total interest rate increases in 2023 are probably going to range somewhere between 0.5 point to 0.75 point to get to their target. Now, there are two outcomes from this, maybe more, but two major outcomes that people are weighing right now, and the Fed is considering. The Fed is worried that if they are not aggressive enough in tackling inflation, it's going to fester and grow. That was one of the problems that happened in the 80s, that the Fed raised interest rates, but then kind of took their foot off the gas pedal, thinking that they had done enough. And then inflation reared its ugly head and really became a bigger problem and harder to control. That was when we went through the most dramatic inflation, and the Fed doesn't want to be in that position again. So they're steadfast on saying that they are going to aggressively tackle inflation, even at the detriment of the short-term economy, meaning even if we go into a recession, they're okay with that if they achieve their bigger picture goal. On the flip side, is what we talked about, the recession. If they are too aggressive, too long, the US could go into a recession, and that isn't good for anybody. And even though the Fed says they don't consider that in their decision making, they don't want the US to be in a recession on their account either. This is a dot plot. I jokingly say that I'm a CPA nerd. That's my base before I went into financial planning, and some of this stuff really resonates with me. But this is a dot plot, and I'll explain what it means. It comes from the Federal Open Market Committee meetings. This one came from December of last year. And this is an indication of where the Fed believes we will be in terms of interest rates. So down here at the bottom, we have the years 2022 through 2025 and beyond. On the axis, we have interest rates, where the Fed believes we should be. So when they met at the end of 2022, the Federal Open Market Committee members got to vote anonymously, which is each of these dots. And this is where they believe that we should be in terms of interest rates in 2023. The blue is just simply the median. If we take all the votes together, that's kind of the middle of where the group believes we should be. And you can see that the Fed expects a target rate, the Fed funds rate, to be just above 5% by the end of 2023. We know we're at 4.25. That's where people are getting that 0.75 point expectation of increase in 2023. I think the interesting part of this chart is the red dot, because the red dot is not an FOMC vote. That is where the futures market is indicating the stock market believes we will actually be, despite what the Fed is saying. So the Fed is saying they want rates to be near 5%, but the market actually thinks we're going to be at 4.5% at the end of 2023. And that's what is priced into the stock market this year. If you look at the future, like 2024, 2025 and beyond, you can see that red dot is still lower than the Fed. The Fed thinks by 2024, we might be at a 4% Fed funds rate. The market is still pricing in lower than that. And the blue line, that median rate by the Fed, it's decreasing every year. So I'll talk a little bit about why that might be, why the Fed is anticipating lower rates in the future. But it's also important to note that this is where the Fed's mind was at December, and things change rapidly. For example, if you think of the Fed funds dot plot at the end of 2021, there were only few members who even anticipated interest rate increases in 2022, and they thought that if there were increases, it was going to be mild. And then lo and behold, we had 7 interest rate increases. They all voted for it, and it was 4.25%. So it was not mild by any means. So again, this is just the pulse of where the Fed was in December, but it's still nice to see what they foresee for the year to come. In addition to raising interest rates, the Fed has also been aggressive in their tightening of monetary policy through reducing their balance sheet. So what that means is the Fed has been cutting the amount of cash in the open market since July of 2022. They have been reducing cash by as much as $95 billion per month. The way that they're doing this is, in 2020, when they were worried about COVID, they were putting cash into the market to increase liquidity and to keep things afloat. Now on the flip side, when T-bills and other treasury securities are maturing, instead of taking that cash and buying another security, they're keeping the cash. So that's how they're taking cash out of the market or tightening the monetary supply. They have reduced cash by $364 billion as of January 2023. And that's brought total assets down to $8.6 trillion. So that's what this chart is showing. If you look over here on the right side, this is the increase of cash put into the market by the Fed during the periods that they were worried, like 2020 through 2021. And here's the reduction, a very sharp turnaround in 2022. So it's been really aggressive policy by the Fed in the last 12 months. And a lot of people are wondering where this is going to lead. It's a cartoon. You can see it saying inflation is already in the rearview mirror. Here's the Fed chair driving the car. And people are wondering, is the Fed going to drive the economy off of a cliff if they stay with this policy for too long? The truth is they've got a really hard job to do. Some people think all this maneuvering, it's kind of like a game of chance or a game of dominoes. This is an example. The red dominoes represent things that have already occurred. So for example, consumer confidence has definitely fallen from the peak of 2021. Volatility in the market, we opened with that slide. It looked like a roller coaster, but that was the stock market going up and down every day last year. The yield curve is inverted. We'll talk about that later, but that's a sign of a possible future recession, and the housing market is slowed. Now, the hope by the Fed is that these red dominoes are going to trigger the yellow dominoes, which is a less competitive labor market, so bringing down some of the inflation around pricing for new employees and reducing some of the stock multiples. So the Fed actually wants some of that high pricing of 2021 to come down and be normalized. And the green dominoes on the far right, well, those are the possible outcomes. And there are only two on this screen, but really it ranges from everything from a big recession to a mild recession, or what people are really hoping for, that soft landing. As we noted, some of these things have already happened. So the red dominoes, new home sales have absolutely decreased as the Fed funds rate has increased. Mortgage rates have also increased, and we have seen a drop off in new home sales dramatically since that happened. On the flip side, with the Fed funds increasing their rates, bonds are actually yielding the highest rates we've seen in about a decade. So bonds are popular again. If you look at the bond yields from this year, from 2022, that's the blue bars, compared to 2021, which are the yellow bars, you can see the increase across almost every sector. 10-year treasuries, they went from 1.2% up to 4%. Of course, for bond investors who had bonds in their portfolio as a part of their component, that was hard because that created a loss on existing bonds, meaning if you were carrying the yellow bars, the 2021 bonds, and then all of a sudden bonds go up to 4% or more, the bonds that you're holding that are yielding 1% are going to lose value in the short term. Now, of course, bonds are always circulating. So as those bonds of the past mature, you're going to use the free cash flow to replace with new bonds at the higher rates. But for 2022 in specific, it was really hard for investors because it is not often that we see stocks and bonds both decrease simultaneously in the same year. So that was tough for the stock market. This is a chart. It's another way of expressing the dot plot, but this is a chart showing the estimate of the Fed funds rate using that future implied rate that we talked about. As you can see from the current pricing, it indicates a peak of around 5%, which is what the Fed was anticipating as well. And that peak is anticipated in mid-2023. And there's anticipated a small reduction by the end of 2023 with a definite reduction in 2024. So some of you might wonder, why would the Fed increase rates and then possibly drop rates towards the end of the year? This might be indicative of the fact that the Fed believes there could be a recession later this year. So the Fed tends to tighten, to increase interest rates when inflation gets out of control and they want to slow the economy. Now, on the flip side, if the economy starts to really decline, maybe it's officially in a recession this year and the Fed wants to soften that landing, they might cut interest rate increases. So this is another indication that possibly a recession is on the horizon. Another indicator of that possible recession would be the inverted yield curve. We talked about that in the domino slide. This is a chart that is showing the spread in the interest rates between the 3-month and the 10-year Treasury yield. Traditionally, an inverted yield curve has occurred before every recession that we've had in the US economy. Now, on the flip side, though, there have been times that the yield curve is inverted and no recession has followed. So it's not necessarily saying that a recession is absolutely going to happen, but we're talking about a severely inverted yield curve at this point. It's been inverted since last year, and it tends to be a negative indicator. You know, stepping back a little bit, looking at the big picture, when investors are buying long-term bonds like 10-year treasuries at a yield that is lower than a 3-year treasury, it doesn't make sense. So you've got to think about why. Why would an investor buy a 10-year treasury that's yielding less than a 3-year treasury? And the answer is investors feel like past that 3-month bill, there's volatility on the horizon, maybe losses that are going to happen, and they want to protect themselves from that anticipated future stock market volatility by buying a 10-year treasury, even if it's at a lower rate than a 3-year treasury. And that's why an inverted yield curve is a sign of a possible recession coming. I feel like I'm giving a lot of bad news, but this is a global recession indicator. So we've been talking about the US mostly up until this point. This is a chart that kind of tracks the global indicators, and globally as well, there are signs that there might be a recession looming as well. So this isn't something isolated to the US. This is a chart by the Organization for Economic Cooperation and Development, and you can see as sentiment declines, these gray bars, that's when the recessions happened. And as sentiment declined, these recessions definitely took place. So here we are, 2021, 2022, definitely a decline in that OECD indicator, but no gray bar yet. You know, when the stock market declines as they did this past year, history tells us that it becomes a buying opportunity because in effect, the stocks that we are buying have gone on sale and they're more attractively priced. We know that if we look at the history of the market, and this is from 1870 all the way to 2020, we know that there have been lots of reasons that the market has declined in the past. All of them are unique. Some of them reflect each other, but the economy has always been resilient. It's always come back from that loss and gone on to a new high. So this chart shows the aggregate growth of the market, incorporating all those historical gains and losses. I do feel like even if 2023 is going to be a volatile year to come, we should look at the big picture, which is that the US economy is resilient. If you believe that the market is efficient, this is a good way to say that stock prices are coming back to their normals. And look at how you can utilize the down market in your long-term investment portfolio. So we'll circle back to that strategy in the end. For now, I'm going to pass the floor back to Aska to talk about Secure Act 2.0, because that new legislation is going to have a lot of impact on 2023 as well.
Thank you, Akemi. So many of you might not have heard the Secure Act 2.0 was actually passed last year. President Biden signed the bill as part of Omnibus Spending Bill on December 29, 2022. I think it didn't cover much headline on media because Secure Act 2.0 has so many little changes and it's not as drastic as Secure Act of 2019. But I'll go over how you may be affected by these changes. The biggest change that may affect many people is Secure Act 2.0 actually pushed back that required beginning date again. So some of you may remember prior to Secure Act of 2019, if you were born before July 1st, 1949, once you turned age 70 and a half, your required minimum distribution started. After the Secure Act of 2019, starting in 2020, if you were born after July 1st, 1949, and once you turned age 72, that's the year you needed to start taking required minimum distribution. So how confusing is this? Why did they pick like age 70 and a half? Or why did they pick if you were born before and after July 1st? I really don't get it. But on that note, Secure Act 2.0 actually made it a little bit simpler for us to understand. So starting this year, if you were born before 1951, there's no changes. So once you turn the age 72, that's the year that you have to take RMD. If you were born between 1951 and 1959, and you actually get one extra year. So your RMD age is actually starting in when you turn the age 73. If you were born after 1960, then you actually get 3 more years, so RMD age got pushed back to age 75. This is actually a great opportunity for Roth convergence. So Akemi is going to go over Roth convergence strategies later in the presentation, so I'm not going to go over too much, but let's say if you retire at age 65 and your required minimum distribution got pushed back to the age 75, you have 10 years to do Roth conversion to lower your RMD amount. So this is something definitely you should be talking with your financial advisor. Some of you who are charitably inclined might be wondering if qualified charitable distribution eligibility age got pushed back as well. The answer is no. So you can still make QCD once you turn the age 70 and a half. QCD is a popular strategy for people, especially who have higher income after retirement, because what QCD is, you can make direct donation from your IRA account to your favorite charitable organization. So why would they do that? Because the donation that you take out from your IRA account is not considered as your taxable income. And then the donation that organization received is not taxable income to them either. QCD can be a whole topic to another presentation, so I'll just stop here. But if you're interested in QCD, let us know. We're happy to discuss with you further. Another change that Secure Act 2.0 did with RMD is actually reduce the most severe tax penalty. So prior to 2023, if you fail to take RMD amount by the end of the year, you were subject to 50% penalty. So let's say you needed to take $20,000 from your IRA by the end of 2022, but you failed to do so, and you were subject to 50% of $20,000, which is $10,000 penalty. Oof. But thanks to Secure Act 2.0, it got actually reduced to 25%. And it can even lower to 10% as long as you make sure to take the amount by the end of second year following the year it was due. Of course, there's a waiver provisions that you can request to the IRS. If the mistake, it was just simple mistake, just forgot one time, you can just submit form 5329 and request a waiver, and the IRS usually accepts that. Secure 2.0 also made several changes with catch-up contribution provisions. Catch-up contribution is an additional contribution that you can make when you're age 50 and over. This is actually one of the interesting things that IRA catch-up contribution was somehow overlooked, meaning, so let's look at the 401k contribution amount. In 2022, 401k contribution limit was $20,500 and a catch-up contribution was $6,500. Those numbers got adjusted for inflation, so now you can make up to $22,500 contribution and also $7,500 catch-up contribution. On the other hand, IRA, in 2022, the contribution limit was $6,000 and the catch-up contribution was $1,000. only the contribution limit got adjusted for inflation. So this year in 2023, you can contribute up to $6,500, but the catch-up contribution amount remains the same, $1,000. So this gap is going to be closed effective in 2024. So IRA catch-up contribution is going to be adjusted for inflation. Another catch-up contribution changes is going to be effective in 2025. This is sometimes referred as a mega catch-up contribution. But if you're aged between 60 and 63, your catch-up contribution limit increase greater of $10,000 or 150% of your standard catch-up contribution if you have 401k or similar plans. If you have simple IRA, it's going to be greater of $5,000 or 150% of standard catch-up contribution limit. Again, this is going to be available only for 4 years when you're aged between 60 and 63. So once you turn to age 64, the catch-up limit is going to drop to the standard amount. Another catch-up contribution change, this actually might affect some people in a negative way. Effective in 2024, if you make more than $145,000, your catch-up contribution can be only allowed to Roth accounts. So some employers are voluntarily offering the employees to make either pre-tax contribution or after-tax contribution to their retirement accounts. This provision is saying that if your employer is not offering you a Roth account, like Roth 401k, you won't be able to make any additional contributions. So it's going to be effective in 2024. I'm hoping more and more employers is going to start offering Roth options. But if not, if you make more than $145,000, you won't be able to make any catch-up contributions. Secure Act 2.0 also made so many changes with Roth provisions. Effective in 2023, Roth SEP IRA and Roth Simple IRA plans are now available, which is great news for people who are self-employed or who are small business owners, because now they can start saving up their after-tax money for their retirement. Great. Another change is after-tax employer matching contributions can go to be allowed, meaning that I kind of briefly go over in the previous slides. But so employee has an option to make either pre-tax contribution or after-tax contributions. But prior to 2023, the employer matching contributions were only allowed to make pre-tax basis. But thankfully, starting this year, the matching contribution can go to after-tax Roth accounts, as long as participant pay tax on the matching contribution in the year the contribution is made. So fair enough, right? Effective in 2024, Secure Act 2.0 eliminates Roth 401k and 403b required minimum distributions. So one less things to worry about, which is great. This one is actually my favorite changes with Secure Act 2.0. Effective in 2024, you're allowed to roll over your 529 accounts to your Roth IRA accounts, as long as you meet certain criteria, which is 1, the rollover must be made directly from your 529 accounts to Roth IRA accounts. 2, Roth IRA accounts must be under the same name as the 529 beneficiary. 3, the 529 account must be held for at least 15 years prior to the rollover. And lastly, rollover amount must be contributed to 529 accounts 5 years prior to the rollover. So as long as you meet those criteria, you can roll over 529 account balance to your Roth IRA accounts up to the annual IRA contribution limit. And the maximum lifetime cap is $35,000. The $35,000 is not adjusted for inflation currently, but I'm hoping that it's going to be adjusted in the future. Next one is also my favorite change. It's effective in 2024, the money you pay towards to student loan is going to be counted towards to your 401k contributions, meaning that if your employer offers matching contribution, they can make matching contribution to your 401k based on your qualified student loan payment. So let's say you make $50,000 and you pay $5,000 towards to your student loan. And if your employer offers 5% matching contribution, you'll get $2,500 matching contribution to your 401k, even if you're not participating in the 401k because of the student debt, which is great, right? Because imagine if you're not able to make any direct contribution to your 401k for 10 years, but still the employer matching contribution goes to your 401k each and every year. Assuming that market rate of return is 7%, your account is going to grow to almost $36,000. So once you pay off your student loan and you're ready to start putting money into your 401k, you don't have to start with zero balance. You have something to start with. So Secure Act 2.0 is actually encouraging younger generation to start saving up for their retirement in the early age. The last provision I'm going to talk about is qualified longevity annuity contracts. This is going to be also another whole topic for another presentation. So I'm just going to briefly go over. But so QLAC is an annuity that you can purchase using the funds from your IRA account or a qualified retirement accounts, meaning that the QLAC is a deferred annuity, so you can defer the distribution until the future date, which is typically person's 85th birthday. So why do they do that? Because so the funds that you transfer from your IRA account to purchase this QLAC is not going to be subject to required minimum distribution. You can actually defer the distribution until annuity matures. So that's the reason why it's a popular strategy for retiree too. But it also used as a hedge against longevity because it provides guaranteed monthly income for lifetime and it's hedged against the market volatilities. This was limited to the lesser of 25% of retirement funds or $145,000, but the Secure 2.0 eliminated the 25% cap and then dollar amount increased to $200,000. So there are so many changes with Secure Act 2.0, especially in Roth provisions, but it actually didn't prevent or eliminate the most popular Roth strategies, for example, backdoor Roth IRA contributions or Roth conversions. It didn't also eliminate the lifetime gift tax exemptions. So in 2023, you can gift up to almost $13 million as a couple, $26 million without triggering federal estate tax. Secure 2.0 didn't include creating non-age-based required minimum distributions. I'm just going to make up the numbers because it didn't pass. But so let's say that if you have $10 million in your IRA account, you need to start taking required minimum distribution no matter how old you are. This didn't get included, so you don't have to worry about it. And lastly, I went over earlier, but the QCD eligibility age didn't get pushed back to match required beginning date, so you can still make QCD once you turn the age 70 and a half. So overall, the Secure Act 2.0 has so many small changes, and it's not as urgent as Secure Act of 2019, like eliminating stretch IRA distribution, for example. But small changes meaning more opportunities for you. So reach out to your financial advisor and make sure how you can take those advantage of these new changes. So that was a Secure Act 2.0 in a nutshell, and then I'll pass it back to Akemi and she'll discuss about investment strategy in current market environment.
Thanks, Aska. Great job. Yeah, we're on the home stretch. I saw somebody was asking if the session will be recorded. It will be recorded. We have to run it through compliance and then we'll get it out to you. In terms of solutions, game plan for the road ahead, we'll kind of start high level with theory, because I think theory on investing and approaching volatility is the main thing. And then we'll talk about some tangible tools that you might be able to employ. I think the first thing is, try to keep a long-term perspective and resist the urge to jump out of the market when we're at the bottom, because that would lock in losses and that would hurt your long-term returns. Another way of saying that is don't get so focused on the minute details, and, the news headlines are very eye-catching, but, don't get so absorbed in that you lose sight of the big picture. Sometimes when you step back, you can get a little bit more perspective and things will get clearer. This is a chart of US equities, so bull markets and bear markets from the 1940s through end of last year. Experienced investors, you've been through several market cycles before. You know that they're unpleasant, but they pass. This chart shows bull markets, which are the green sections above the line, as well as bear markets, which are the blue sections below the line. And you'll notice that the number of positive and negative bull markets, they're pretty much even, but the size of the recovery, the gain from bull markets far exceeds the losses that are experienced in those down years. You look at bull markets, average annual return of about 138% versus bear markets, average annual losses of close to 30%. So one thing to keep in mind is, we did have about a 20% loss in 2022. It wasn't the worst loss we've seen. Thankfully, it wasn't like 2008, where we saw a 40% decline in 1 year very rapidly. In fact, we saw a pretty good Q4 where we had some gains. But the fact of the matter is, these are a part of a market cycle. It takes bubbles out of the market from forming, and there are gains on the other side where you make up your losses. And that's a good segue into this chart. It's a study that was done by Eugene Fama. He's one of my favorite economists. He won a Nobel Prize as an economist, and they studied US total market returns for about 100 years, 1926 through 2021. And so we know that, the past is not any indication of future performance, but if we were to look at the past as, a data point, when we look at past market declines, and then we look at the trajectory of recovery, how swiftly did recovery come? And in this study, they took the last 100 years of data, they bucketed losses into 10% declines, 20% market declines, and 30% market declines. And in the first two scenarios, what you can see is that the recovery 1 year out from the bottom, in retrospect, happened pretty quickly. In a 10% loss 1 year out, you got a 12% recovery, and 20% loss, 22% recovery 1 year out from the bottom looking backwards. And in fact, if you were in there 3 years from the market bottom, cumulative return of 30 to 40%, and 5 years out from that bottom, we're talking 70% market return. So we know that recovery comes swiftly. Sometimes they don't even call the recovery until you're like 1 year in and you've made up your losses. But this is the reason that you don't want to try and be smarter than everybody else in the market. The market moves quick. You want to make sure that you're positioned to withstand volatility. Now, granted, a 30% market decline is not nearly as clean as the first two scenarios. You can see from the first year, there is a significant recovery. Don't quite make up losses of 30%, but you get close. But this is the interesting part. After a 30% market decline, quite often 3 years out, there was a dip. Some people call that a double dip or a W-shaped recovery, but what it means is there's some external factor that needs to be addressed and fixed before the economy can get back on the plus side. 5 years out, there's a full recovery, but it's not as smooth of a recovery. Now for the US, total stock market, we were down about 20%. If you look at some other sectors which are narrower in scope, like let's say NASDAQ, which is very tech heavy, losses were a little bit larger, towards this 30%. So I don't know what our recovery is going to look like, but I do believe that recovery will be on the other side. And it's important to talk about the emotions of investing, because we look at all these charts and we look at the numbers and we say, well, this is what we should do. But it's okay to say that investing is very emotional. The other thing, though, is to remember that each market cycle does present opportunities. Here at the top of the stock market, people tend to feel exuberant. They're very optimistic. They want to buy things. However, what they don't realize is that's actually one of the riskiest times to be in the market because things could be overpriced. The market might be due for a correction. As you roll down this hill and you get towards a market dip, understandably, investors would get very nervous. You might even start to second guess your investment philosophy or think about cashing out. However, if you acknowledge the emotion, but then try and look at it logically, each one of those presents opportunities. So, for example, at December 2021 at Kondo Wealth Advisors, we were actually rebalancing our portfolios. It was hard to do. Emotion, right? Stocks were having double-digit gains. The last thing I wanted to do was cut off that gain and move it into a lower yielding asset class. But we follow our theory on diversifying and rebalancing, and we locked in those gains in 2021. That was a great thing because we didn't know that 2022 was going to be such a tumultuous year. When we were in the bottom, like September of 2022, we were also very busy, but we were doing different things. At the end of 2022, we were doing loss harvesting. So, realizing losses to offset tax liability on capital gains. We were doing Roth conversions, moving assets from a pre-tax vehicle to an after-tax vehicle so that when recovery does come, it's tax-free in a Roth vehicle. We were also doing dollar cost averaging, so taking some of that cash on the sidelines and strategically getting it back into the market. So there's opportunity at each one of these if you look at it correctly. Now, if the volatility from last year didn't look like opportunity, it caused your stomach to hurt or it caused you to not sleep at night, that's an issue that should be addressed as well, because at the end of the day, health comes first. You want to make sure that your investment allocation is appropriate for you. This is a chart about the ways that you can invest. People will refer to this as risk tolerance. You can be on this highly aggressive side where you have more stocks than you do bonds. And in fact, a lot of people have portfolios that drifted that way, either because the stocks grew so rapidly or because the bond yields were so low, people were pushing into stocks to try and get more yield to keep up with inflation. However, in 2022, that super aggressive portfolio might have gone on the bottom side of this black line, meaning it lost. Super aggressive portfolios have higher gains on the upside, but they've got lower lows on the downside. If that bothered you, you might want to look at the risk tolerance and determine if you need to find another balance that is right for you. Sometimes we do that when the market shifts and you realize that maybe your portfolio needs adjustment. Other times you do that when you're going through a life change. Like, for example, when you're shifting from being a working employee who is utilizing down markets in their portfolio to being a retiree who wants to maintain the portfolio, capture market growth, but really reduce some of that volatility. Diversifying your investment portfolio is also an effective way to manage risk, reduce volatility. In the past couple of years, it's been kind of easy to drift into stocks or drift into large cap growth. This is a simplified Morningstar style box. Large cap growth is often resembled by the S&P 500, but that's where a lot of investors go. Has great growth on the upside, has also more volatility on the downside. One thing you might want to consider is diversifying your portfolio. So have some value stocks, things that maybe didn't do so well in the past because of COVID, but are probably going to have really good growth trajectory in the future. You also want to have small companies to complement your large company stocks, because small companies, they can pivot faster, right? When things change, tax laws change, small companies can pivot, take advantage of that and have exponential growth versus a large company. It's a lot harder to enact changes quickly. Now, you'll notice that this Morningstar style box is located over the US domestic investments. It's also important to recognize that global GDP, 40% of it comes from other places outside of the US, and you don't want to exclude all of that from your portfolio and miss out on that loss. The reason being, US and international tend to have inverse correlation, meaning one tends to do well when the other is not, and vice versa. An example, in the 90s, the US did great, international was flat, and then the dot-com bubble burst and we flipped. The US had their lost decade, very few gains for a 10-year period. If you didn't have international in your portfolio, you might not have had gains during that period. And a lot of people say that switch will continue to happen. Last 10 years, US has had really good growth. Could this be the switch where maybe international is going to shine? Oh, advanced too quickly. Sticking with inverse correlation, when you put two inversely correlated assets together in the same portfolio, they tend to benefit you because the gains tend to outweigh the losses. And when you put them together, you tend to reduce the volatility. So let's just pretend that the red line is US investments and the blue line is international. They go up and down at different times, but if you put them in your portfolio together, you get that investment portfolio, which is the green line. And you can see it goes up and down. It's not immune from volatility, but it is certainly not as high, low, lows, meaning you can get from point A to point B and probably sleep a little better at night. This idea of diversifying your portfolio, investing to get markets rates of return, taking the optimal amount of risk, it's called modern portfolio theory. And it was a thought that came out of the University of Chicago by three economists in the 90s, Harry Markowitz, Merton Miller, and Bill Sharp. They actually won a Nobel Prize for this idea. Back then, you had to have like $10 million to do this because diversifying meant buying 6,000 different stocks. Now you can do it in a much easier fashion utilizing ETFs and mutual funds where you get that same diversification in a smaller portfolio. So that's a philosophy. If we were to drill down to some examples of how you can use this market to your advantage, one of the things that Aska was talking about earlier was Roth conversions. So for example, taking money from your traditional IRA and then transferring it to your after-tax Roth IRA. You know, the way you want to think of it, if the market dipped 20%, what if you move that 20% lower value to your after-tax vehicle? If you believe that the market's efficient and it's going to recover, why not have that 20% gain be in your after-tax, tax-free Roth IRA? One thing to consider is that transfer from the pre-tax IRA to the after-tax IRA, it does trigger tax. So you want to be cognizant of that. But this is just a pictorial view, a cartoon about this. We say that the money that you move into the Roth IRA, that's the seed. And this guy's saying, I only had to pay tax on the seed and look at the harvest that you can get. So investing in a Roth IRA for the long term can be beneficial because the earnings are tax-free. The other thing is once you're inside of a Roth IRA, the Roth IRA is not subject to required minimum distribution. So you've got better control over your taxes as a retiree. And if you don't use that money during your lifetime, and maybe it goes to your heirs after you're gone, it goes to them tax-free as well. So lots of benefits there. Roth IRA candidates, that would be people who have high retirement income. If you think that your income is going to be really high in retirement, you might want to consider paying tax on it now. Also, people who will pay higher tax rates in the future. You know, you want to think about the fact that once you're retired, you might have pension income, Social Security income, required minimum distributions, your portfolio might grow. And if that grows, you might get more dividends. So if you think your tax rate could be higher in the future, you might want to consider paying tax on that now through a Roth conversion. Or let's say that you have low income years. Maybe you take a break from working. That might be an ideal year to do a Roth conversion. Or like Aska was saying, maybe you retire at 65, but you don't need to take required minimum distributions till age 75. Those lower income years might be a good Roth conversion opportunity. People who want to leave tax-free income to their heirs might also like Roth IRAs, but please talk with your CPA before you do the conversion because you don't want to be surprised and get a big tax bill. You want to feel like you made a decision with all things considered. This is an example to just kind of solidify that point of who might be an ideal candidate. Let's pretend that you are working and in 2022, age 65, you decide to retire, so your working income drops. You predict that at age 70, you're going to take Social Security income, so your income would bump up in those years. And at age 75, you're going to have to start taking required minimum distributions. You can see this big gap of income in this period where you just start to retire. So for tax purposes, it's like your income was high and then it's low and then it gets large. In fact, by retirement years, income tax might even be higher than it was when you were working. Now, what if you use those lower income years to do Roth conversions instead? So these yellow bars, let's say that when your income drops because you're no longer working, you do Roth conversions to bring your income level back to what it was when you were working. Now, from an IRS perspective, they don't care where the income comes from. As long as you pay tax on it, they're happy. But to them, it looks like your income is the same even once you retire. Now, at age 70, you start taking Social Security, so you lower your conversion amount. And this is interesting. By age 75, when you have to take required minimum distributions, because you have converted most of those assets to the Roth IRA, the amount of RMD that you have to take is lower, which means instead of having that decrease and then a big grow up of retirement income, you have a much steadier line. So you have much more control over your taxes in retirement. Another strategy that you might want to consider in a down market is dollar cost averaging. You probably heard the saying that investing regularly in good times and bad times is going to help your long-term portfolio. And it's true. Consider if you were investing a fixed amount every month, like let's say you were investing $300 per month. You don't have to worry about whether the market's going up or down. If the market is high, let's say a stock is selling for $30 per share, your $300 is going to get you 10 shares. On the flip side, when the market dips, if you're still investing the regular amount every period, that $300 is going to get you 30 shares. And you can see how the number of shares adjusts to the market volatility. If you're doing this in something very steady, like a 401k contribution, where the contributions to your retirement plan are coming automatically out of your paycheck, you have less to think about. It's automatically going into the market and it's efficiently buying. You're not overbuying when the stock market's too hot, but you're absolutely taking advantage when the market is down. That helps your average share price that you're purchasing, and that helps your bottom line. So that's a good strategy. This is a chart of the Dow from 2008 through 2022. Just to kind of put things in context, a lot of people were scared during 2008. It was a scary time. Sometimes people stopped contributing to things like their 401k during that time because they felt like the market's really scary. I'm going to wait for things to normalize and then I'll start putting money into my retirement account again. If you're a long-term investor, this is actually a great opportunity to buy. You want to continue those regular contributions because down markets will work to your advantage in the long term. At the same point, when the market is at a high, even if you're doing those regular contributions, you'll still be saving, but you'll be buying less when the market is at a premium. I know we showed you this chart before, but I just want to go back to this because some people say, oh, but it's different this time. This is a once-in-a-century pandemic, and that's true. It's been a scary time, and each one of our market declines historically have been different from each other, different catalysts, different outcomes, different government responses. But one of the consistencies is that the U.S. economy is resilient. We've navigated several different circumstances successfully in the past. If you believe that the economy is efficient, we'll get through this. We've been through declines before, and we'll make it through this one as well. Last strategy I want to talk about, and then we'll move into Q&A because we're running through our time. Loss harvesting. We mentioned that when the market is down, you could also realize losses on that investment that is down to generate a tax offset or to reduce a tax due on a capital gain in the future. Now, if you don't have capital gains in the same year as the capital loss, you can carry it forward indefinitely. And when you don't have capital gains, you can offset it against your ordinary income for $3,000 a year. So running through this really quickly, let's say that you have a stock, you're selling it at a gain of $10,000, you have no loss to offset it, and you're in the highest tax bracket. You didn't hold this for a year, so it's taxed at ordinary income rates. That's a $3,700 tax. You're netting $6,000. On the flip side, let's say you loss harvested before, so you can carry this forward. When you sell something at a gain for $10,000, it's offset dollar for dollar with that loss, which means you don't owe any tax on it and you get to keep 100%. So definitely consider that. Talk with your CPA if you think that's appropriate. Your financial planner can help you implement that. These are the investment strategies that we employ at Kondo Wealth Advisors. We would be happy to advise you on that if you think that's something that you're interested in. We have been serving the community since 2007. We work with individuals and small businesses. We are an independent registered investment advisor. That means we are not under the parent company of any bank. Our only bosses are our clients. These are some of the services that we offer. The bread and butter of what we do is retirement planning, but we really want to understand your goals and help you achieve those goals and give you the right tools along the way. We specialize in retirement planning, but we also help with passing income from generation to generation. We also help with growing income through financial plans. Young people are stretched thin with trying to pay down a mortgage, save for their retirement, put their kids through college. And we get that. We can help you with that. And we love working with young investors too. We serve a niche market of Asian Americans because we understand that there are cultural sensitivities about money. We respect that, and we want to be transparent with you and service you to the best of our abilities. So this is our team at Kondo Wealth Advisors. We would love to talk with you more. I'm going to transition into Q&A because we had some really good questions come through. Aska, you want to join and we can start doing that? For those of you who have already submitted questions, we'll start with those. For those who want to still, you should have that Q&A button at the bottom of your screen. You can submit the question real time and we will get to answering those. So, Aska, let's see, I'm going to pull up some questions here. Give me just a sec.
Sure.
Got to toggle some screens, sorry.
No problem.
All right, so thank you guys for submitting the questions. One of them is holding a money market fund better than a short-term or a limited term bond in 2023? All of these answers kind of start with that caveat, like it depends. So this one too, it depends on your circumstances. If you're in a high income tax bracket, you don't need these funds for any time soon. Yeah, a municipal bond might be a great opportunity right now because you can get tax-free interest and you can lock in some of our rates, right? Like if that futures market is right and rates are going to come down at the end of the year, maybe now is a good time to buy a limited or short-term municipal bond. On the flip side, let's say that you have a short-term savings that you want to park somewhere and you want it to be safe. Maybe it is to pay some bills down or do a home renovation, or it's a down payment for a new home. If you have anything that they consider short-term, which is like 1 to 3 years in the market, you don't want to put it in a bond fund. You might want to choose something like you were saying in this question, a money market fund. Money market, and I'm kind of like throwing in like CDs and high yield savings. There are definitely some online banks who are paying 4% and above on free cash flow. And I know you can definitely get that on like a 1-year CD. So depending on your circumstances, both could be a good vehicle to park funds short term. Let's see. Going through these, I think we talked about a lot of these questions, and Joni's answered a lot of these questions in the seminar. So thank you, Joni. One of these words of encouragement so we can enjoy the quality of life. That is a very good point. Sometimes we talk about all these worst case scenarios, but we've been through this before. There are opportunities in this market. When we are doing retirement planning and investment planning for clients, we are looking at all of these different scenarios and trying to incorporate them. We don't want to be over optimistic. And I think sometimes maybe that causes someone like me to sound a little bit pessimistic. I showed you all those charts of negative sentiment, but really all I'm saying is be prepared for volatility this year. Don't be overly optimistic because that can be risky, but these are absolutely things that we've incorporated into your financial plans. These are things that we believe will happen and cycle in the market. And that's why we bring your average annual returns down to cycle in both good years and bad years. And I wouldn't be worried. That's what we want to be here for, so that we can worry for you and you can enjoy retirement. Here's a really good question, Aska. What is the best way to downsize your home and increase your retirement income without paying any capital gains taxes?
Oh.
I know.
That's a great question. And I believe many of you are going to start considering downsizing the house when you retire, who wants to have like stairs in a house, but you want like flat single house. So if you're talking about your primary residence, and then you can actually exclude up to $250,000 gain per person. So if you're a married couple, you can exclude up to $5,000. So if your house appreciated less than exclusion amount, you can actually offset the gain with the exclusion amount, meaning that there's no tax owed. If your house appreciated more than the exclusion amount, let's say you're a married couple, you have more than $500,000 appreciation with your house, then this is a great time to talk to your CPA or financial advisors and then look for the opportunity to do loss harvesting. That was the one that Akemi was explaining earlier, because you can offset the capital gain with the capital loss, and then the losses can be carried forward indefinitely. So you can start accumulating those losses for the future use if you are looking or if you're anticipating to sell the houses in the future years.
Absolutely. And, that is probably a very particular circumstance too. So feel free to reach out to us, because there could be things like maybe you did a home renovation that brought up your basis, just things that you've done that through the process of conversation, we might discover that creates more possible tax savings for you. So please contact us if you want to talk about that more. Here's a question about QLACs. Aska, you are absolutely correct. There's so much information there. We could do a whole webinar on it, but I think you did a great job of highlighting the basics, which is that this is really a hedge to create more income for yourself when you're retired and defer some RMDs. So there are vehicles out there. Please reach out to us if you guys want to discover if those might be appropriate for you.
Here's one question coming in, Akemi, do you want to answer? So this person is asking, how does raising the debt ceiling by Congress affect retirees? Do you have any opinion on that?
Yes.
Of course.
I put a slide together last night for you guys on this one. Thanks for the lead in, Aska. I didn't want this one to go to waste. So the debt ceiling, we did hit the limit yesterday, 31.4 trillion. And I don't know about you guys, but that really blows my mind when I hear it. The federal government is saying that they will employ extraordinary measures that's going to carry the U.S. debt until the summer. And Treasury Secretary Janet Yellen, very experienced, very, very respected, is kind of leading this cause. But what it means is we're going to need negotiations to start now. And when I say negotiations, we've got funding that we could probably do until summer to make good on our debt. That funding is unfortunately done by suspending payments to federal pensions. So essentially, the government is borrowing from itself. It's writing IOUs to government pensions to create cash flow to cover their debts. And they can only do that for so long. So way in the past, debt ceiling increases used to be done by phone. It was like almost a non-issue. In the last couple of decades, though, it's been utilized as a negotiation tool, meaning in order for all the members of Congress to sign off on the debt ceiling increase, they're asking for something. So more likely than not, that is going to be an ask for the president to reduce spending. And that's why I said negotiations need to happen. They need to start now so that we don't get into a point where we can't make good on our debt. Currently, our debt is 120% of GDP. If we're looking at percentages, it's higher than it was in World War II. I'm a CPA, so I don't like seeing that percentage. But I think going back to the question, I get a little lost in thought. How is that going to affect us this year? When we hit the debt ceiling in 2011 and we didn't negotiate an agreement right away, the credit rating agencies actually dropped us. We went from the strongest rating, AAA, down to a AA rating, and that's where we stand today. The reason being, U.S. is supposed to be one of the most secure debts in the world, but it shows this inability to negotiate and come to an agreement. At the same time, not only does that debacle make us look bad in the global economy, it hurt the stock market in 2011. The stock market declined 10% when that happened, when the debt ceiling the agreement was not reached timely. And I know, looking at the 20% loss year, nobody wants another 10% loss this year. So I hope Congress can get it together and come to an agreement by the summer. But man, Kevin McCarthy's just got in there and he's got a lot to tackle already. Thanks, Aska.
Thank you.
Do you want to answer this next question about long-term investment opportunities in tech, healthcare, and consumer staples?
Sure. So tech stocks can provide good long-term opportunities as long as you pick the quality companies. So you have to know like the low debt and profitabilities or strong balance sheets. But these things are so hard to keep track on. So the best thing probably you might want to just ask your financial advisors and keep track on that for you. But overall, just stay away from meme stocks like GameStop and AMC a couple years ago, or cryptocurrencies. That's my advice on tech, healthcare, and consumer staples. They're usually do well in recessionary environments. So this might be a good time to have some of those, but just don't put too much overweight in one sector because, we all know the market just turn around really quickly. So you don't want to miss any of the opportunities that happen in other sectors.
Yeah, good point. Diversification is key. You don't want to chase the hottest high performing stock that tends to be right when it corrects itself. So diversification will help you capture gains everywhere, not just in defensive stocks or growth stocks, but a blend of both of them. Picking up a few more questions. Are we financial advisors? I'm sorry if I didn't explain what we do very well. Kondo Wealth Advisors, we absolutely are financial advisors. We do goals-based financial planning. So some people, like, for example, if you go to a brokerage house, they may call themselves a financial advisor, but what they're really advising on is just the investment. And sometimes they can only do one thing, like commission-based funds or ETFs. We're duly licensed. That means we're registered directly with the SEC. We can do fee-based investments. We also register with FINRA so that we can help with commission-based products. Because you can put a great financial plan together, but if you don't address that there might be risks down the road, then your financial plan can have a lot of risk. So we are financial advisors. We work very closely with our clients' CPAs and attorneys to make sure that from a financial perspective, all of those things make sense and you're getting consistent information. Something unique about our firm, Joni, Aska, and I as the advisors all came from tax firms to begin with. So I came from PricewaterhouseCoopers. Joni was actually at Anderson and Ernst & Young, and Aska was at Grant Thornton. And I bring that up because I think the two very closely intertwine, at least in my opinion. I mean, it's hard to make any decisions without thinking about what is the tax consequence of that. And we are always thinking about how those things complement each other or should be cautious of. And so when we work with our clients, that's something that we try to give well-rounded advice on. I dare to say that our CPAs from our clients speak highly of us. They say that your clients never come to me with a surprise. Like if there's a transaction that happened during the year, usually you let me know in advance, you get it on my radar, and there are no surprises in April when we're trying to do taxes and all of a sudden there's some big liability. So we don't want you to be in that position, and we really want to make sure that you get good advice. But we are financial advisors, we're independent. That means we can work with different banking institutions to house your money, but we are not employees of anybody other than our clients, and we are part of Kondo Wealth Advisors. So I hope that answers the question about advisors. What are the criteria to become your clients? What amount of assets do you have? And what are the fees for your services? We work mostly with individuals and small businesses. We feel like that's our bread and butter. And we work with middle market. So a lot of people go after the high net worth. They only want you if you've got, 5 million to invest. And we really feel like the Asian American market has kind of been underserviced. People have not given the best advice or best attention to that market. And that's actually where we specialize. So we have a minimum investment size of $500,000. If you guys have a retirement portfolio you want us to look at, bring it over. We'll give you a free opinion on it and give you some advice. In terms of fees, we segment them by the services we provide. So for example, if we're doing a financial plan, so we're looking at where you are today, 10 different goals you want to incorporate, and the end, we do a flat rate fee for that. We look at your plan, decipher how complicated it's going to be, and come up with a flat fee. If we're doing investments, investment management, so let's say, for example, we do a financial plan, you say, that's great, here's my retirement portfolio, make that plan happen for me. We can manage the investments for you, and we charge a tiered schedule. So it starts at 1.5, goes all the way down to 0.5%, depending on how much you have invested with us, comes directly out of the investment account. We really want to say that for our investment strategies, we believe that what we charge you, you make up in growth in the market. Meaning if you'd done it on your own, you might net what we would get you if we were to invest it for you, take that burden off your plate and invest in a strategy and continually incorporate all the new tax law changes and market circumstances. Commission-based products, if you wanted life insurance, long-term care, those are actually priced by the carrier who offers them, but it's a percentage. So happy to talk with anybody about those. But for anybody who's looking for advice, we're offering a free initial consultation to everybody who attended today. So you don't have to decide you want to work with us, but if you say, I have a question on this, give me an opinion, we would be happy to give you an opinion on that. And if you decide to work with us, great. If you don't, I hope we give you some knowledge that you guys can take with you. Should I keep going, Aska? I know we have a few more questions. Forecast for ESG funds this year. Do you want to take that?
Sure. The forecast for ESG funds, so the largest component of Biden's Inflation Reduction Act that passed last year was actually focusing on cleaner energy. So yes, the ESG funds is going to be here to stay. But the one thing that you might want to be careful with is it's so ESG did really, really well in 2021, and it got hit really hard in 2022. Like, as you know, the Akemi went through earlier, but energy sector was doing really, really well in 2022. That tends to be eliminated from ESG funds usually. So that's the reason why there was nothing to offset the down market. But the overall, so it's higher highs and lower lows. So you just want to make sure although you're having the ESG funds, your overall portfolio is well diversified. So that balancing out.
Yeah, absolutely. 2 questions and then we'll close. One was on the 529 to Roth conversions. Is there a limitation on 529 to Roth accounts if the beneficiary is changed just before requesting the transfer? Fantastic question. Yeah. There have been a lot of questions about this. It's so brand new that people are asking all these questions. There's been a lot of strategy on the different charts where they're saying, well, if you have to keep a 529 open 15 years before you can transfer it, maybe the day my kid's born, I open it and I put $1 in it. All I have to do is make sure I put the bulk of the money in 5 years before I want to roll it over to a Roth IRA. So some people are talking about these strategies, like just opening a 529, put $1 in it, and the time clock begins. There has not been clear policy as to whether you can change the beneficiary and then immediately roll it over. But because there hasn't been anything saying you can't do it, the answer right now is people say yes, meaning, like we've talked about before, you could roll over that $35,000 to one beneficiary if there's excess, because that's the cap that you notice Aska is not inflated. People are asking, well, could you change the beneficiary on the remainder and do another $35,000 rollover? Very, very creative. I think that the IRS will address it. We've got a little bit of time, but these are all the questions that people are talking about. And Aska, like you said, there's just a lot of opportunity in that space. People should fund 529s. I call them kid Roth IRAs because the earnings are tax-free if it's used on education expenses. And it actually is kind of a Roth IRA now, because if you don't use it for education, you can roll it to the Roth. But great question. And I think there's going to be a lot more clarification around that because there's a lot of strategy being discussed around there right now. Last question. I'm going to present it to both of us, Aska. Mr. Shishima is asking who's going to win the Super Bowl.
Oh, great question.
My husband said 49ers. I asked him if that was real or just a pipe dream. He says it's absolutely feasible. Do you have an opinion, Aska?
You know what? Did you forget that I was born and raised in Japan? So I don't even watch Super Bowl, Akemi. I don't even know the team names.
We're gonna induct you into American culture. We're gonna have to make you watch more football, Aska.
Yeah,
So
maybe next
on that,
presentation is going to be about Super Bowl then.
there you go.
Yep.
All right, guys. Thank you for attending the webinar today. We appreciate you guys so much. I know there were a lot of really good questions. If you have anything else, please email us, call us. We'd be happy to answer it for you. Thank you and have a wonderful weekend.